afternoon, everyone. My name is Sriram from the Commodity Research Desk at Reliance Securities. Welcome to the weekly commodity market update. Last week it was all about the Fed meeting outcome and, of course, outcome from other central banks. Of course, the Fed left the benchmark fund rates at 5.25 to 5.5% range as expected, but sounded slightly hawkish on the future rate hikes for this year. The FOMC dot plots of interest rate projections released along with the statement showed policymakers still foresee one more rate hike for this year. They also raised the median fund rates target for 2024 and 2025 by 50 basis points, signaling that the Fed is expecting interest rates to stay higher for a longer period. This pushed the 10-year benchmark higher and the dollar index higher, and this weighed on the bullion markets, especially silver prices corrected significantly last week. Surprisingly, apart from that, we had the Bank of England and the Bank of Japan policy as well, but surprisingly Bank of England kept rates steady and statement release was slightly dovish, which also supported the dollar and weighed on bullion markets last week. Looking ahead for the coming week or so, we see the spotlight will be on the PCE price index, the Fed favored inflation gauge, the personal income and personal spending data, which is keenly looked at by the Fed for their future rate hike guidance. That will be the key trigger. Prices could also but face headwinds as the US Treasury yields and the dollar index continue to remain higher this week and is expected to remain elevated in the coming week or so as the Fed and other central banks rate interests remain elevated for a longer period of time, which will continue to weigh on sentiments going forward for the bullion side of things. Of course, some profit taking for the treasury yields and the dollar index cannot be ruled out, as investors could slow the pace of selling bonds and reassess how far the rates have gone up. But overall, we do see for more correction in store for gold and silver prices going forward in the coming week or so. The other data expected to be released in the coming week will be the US GDP numbers along with US durable goods orders, and that will be the key trigger for the markets along with the PCE price index this week. On the charts, the range for MCX gold December contract is between 58,475, 58,500 on the lower side to 59,100 to 59,200 on the upside of things this week. In the overseas market, we see a range of 1885 on the lower side to 1930 on the upside of things for gold this time. Moving to crude, both domestic and international prices started the week on a weaker note on profit taking, and after investors turned cautious after the Fed kept rates unchanged and warned about another rate hike in this year. However, after a brief sell-off, we saw the prices turned higher after Russia said it will ban gasoline and diesel exports in an attempt to stabilize the domestic markets and prices as well. The ban will take out about 1 million barrels per day of fuel supplies, or about 3.5% of global demand. The ban could also lead to a sharp rise in US diesel exports to Europe and other parts of the world, which in turn could mean a ramping up of US refining activity and increased crude oil demand. Additionally, prices also found support after a sharp drop in last week Baker Hughes' weekly rig output count, which triggered some buying, as the data could mean that US production is nearing a peak for now. That will depend on the demand going forward, how much of demand for the US side of things come in over the next few months. But that supported the markets in this week. Looking ahead, we see inventory data along with the dollar movements could be the key trigger for crude oil prices. Of course, supply concerns linger in the market, but the dollar remains elevated and will continue to keep any meaningful upside limited for crude oil. Additionally, US crude oil stockpiles rose last week by about 1.6 million barrels per day, as per data from American Petroleum Institute, and the official data is scheduled for tonight. And a small build can pull prices back down, but we feel that markets could continue to move higher on the back of supply concerns. Of course, other triggers like US GDP number this week will also move the markets, and weaker than expected numbers will keep the upside momentum capped for crude oil prices, as demand could take a hit if data remains weak from the one of the largest consumers of oil. So markets can remain range bound. Bias will be slightly positive for the coming week or so and will be data dependent. On the charts, we see NYMEX WTI November range will be anywhere between $88.50 to $94 on the upside, and MCX October contract range will be anywhere between 7,400 to 7,800 this week. Finally, onto the base metal complex. The complex continued to weaken further this week. Earlier, hopes about a recovery in consumption in China gave hopes to investors that problems in the crisis hit property sector in the country had begun to ease. However, after a brief uptick, prices gave up all its gain and ended weaker amid weak demand concerns. Highlighting apparent weak demand in the market are copper inventories in the LME warehouses, registered warehouses, which have risen to 163,000, or I should say 163,900 tons, up by more than 200% in the month of July. Additionally, the higher for longer approach by several or key central banks over the next few months will also keep demand restrictive going forward. Looking ahead for the coming week or so, we see metal prices can struggle going forward. Earlier today, data showed profits earned by Chinese industrial firms fell by about 11.7% from a year earlier in the first 8 months of 2023 amid weak demand in China, of course, and abroad, and persisting margin pressures there. So that continues to signal that the property crisis and the worries for the downturn of the Chinese economy is not done yet, and we see more correction on the back of that. Apart from that, we have the US GDP number tonight, or I should say this week, and inflation numbers from the US on Friday, which will be the key triggers for the market. Additionally, China will also remain away from the market on next week on account of holiday week in that country, and this will also keep demand subdued. So we cannot rule out further correction for copper and other base metals going forward. On the chart, we feel that MCX copper October contract range is anywhere between 700 on the lower side to 730 on the upside of things. So that's it from our side. Thank you very much for watching. Have a pleasant day and a week ahead. Thank you.